Welcome to Wiser Wealth Management Roundtable, where we believe the best financial advice should always be free of all conflicts of interest. I'm Brad Lyons, and with me is Matthews Barnett. Hi, Matthews.
How's it going?
Going well, thank you. Well, today we're going to listen to Casey Smith's interview with Jordan Sute of Sute CPA and Associates. Jordan is a CPA doing tax work for small businesses and individuals and has agreed to join us on a podcast and share her thoughts on the tax code is today and how it affects clients and business owners. You know, it's amazing how much taxes are integrated into a financial plan. We spend a lot of time on tax work and preparation, although we're not CPAs. It's amazing how much time that we spend on taxes and with our clients. You spend a lot in the financial planning process talking about taxes with clients, don't you, Matthews?
Yeah, as we mentioned, we're not CPAs, we are CFPs, but we work on, tax efficiencies and reduction strategies. We're actually currently working with a lot of our clients on their tax returns so that we can do Roth conversion analysis or tax efficiency analysis with doing capital gains harvesting. So there's a lot of options within financial planning that you're looking at taxes without filing taxes. We run across it a lot when we see clients trying to do online software to file their taxes. And a lot of times it's really, if you want to get in detailed analysis, you need to speak to a professional like a CPA. So this interview, I think, is going to be interesting to explain how they operate and some of the best practices that they're able to help clients.
Well, we've partnered with Sute CPA for a number of years now, and that ability has given us to, transfer back and forth client information, given us the okay to do so that we can keep up on their taxes relative to their IRA withdrawals, minimum required distributions, tax loss harvesting whenever available to the client. So looking forward to this interview, and I hope all of our listeners enjoy.
I am here today with Jordan Sute of Sute CPA. Hi, Jordan.
Hi, Casey. How are you?
Doing great. Thanks for coming in today.
Thanks for having me.
So a little background. Michael Sute is your uncle.
Correct.
So we're keeping it all in the family.
Yep, all in the family.
Sute CPA, except for David. What is David now? David's he's an outsider?
I guess so. He was the original, though. So, yeah.
He was the original partner.
Yeah.
We work closely with Sute CPA. A lot of our clients use your services. And so I thought I'd bring you in today to talk a little bit about taxes and all that boring stuff that we'll try to make it a little more entertaining today.
Yeah, definitely.
So let's have a little background about you, just so our listeners can understand where you're coming from. You're a graduate of Auburn.
Oh goodness, no. Oh gosh, no.
I had to say
don't get that mixed up.
I had to say it. You're a graduate of Alabama.
Correct. Yes, born and raised in Alabama. Graduate of Alabama. Made my way over to Atlanta for my first stop in my career at a Big Four firm. I was there for a little over 3.5 years and got to see all different sides of tax, international, state and local, corporate, partnership. Great opportunities to learn there. And then an opportunity arose to come out to Cobb County and work with Michael and his team, and I just couldn't say no. And so it's been a great first year working with Michael and David, and everybody have loved everything I've learned and all the opportunities I've had so far.
The big firms, they tend to do burnout. I see it on the corporate side too.
Yeah,
even
definitely.
The Fortune 500 companies, they hire a bunch of people out of college and then they work them as hard as they can. The ones that survive, and the ones that don't. No one really cares.
Right, yeah. And I definitely experienced a little bit of burnout, I would say. The work-life balance is different there than it is than what I have now. But that was the perfect time for me, being right out of college to go. And I didn't have anything else tying me back, holding me down. So I just worked, learned as much as I could. And then when the opportunity did arise after that first, promotion cycle to kind of explore options, the best one, called out here, and that's what I came for.
Well, I know that they're glad to have you. So let's talk a little bit about just women in accounting these days. There's a shortage of women financial advisors for sure. I think there's more interest going forward. We're starting to see some of that coming out of college. Women CPAs, women financial advisors, I've always thought they ought to be one of the best because it's a job that requires listening.
Right.
And women are typically good listeners.
Right.
Right?
Yeah, I completely agree. And I think that for women CPAs and women accountants, when I started at the big firm that I did, over half my class was women. And so I think that was something that has been different from years past, and it's trending that way just naturally. And even in school, we had a lot of women that were majoring in accounting. And so I think back on, women I know that previously worked in accounting, years back, and they talk about their experience, and it is completely different, 180 from my experience. And so I feel like there's obviously still growth there for women, and it's never, probably going to be completely equitable, but we are at a much better spot now than I think we used to be. And that's because of strong women, leadership, and then men also, recognizing the strong women in the field and the opportunities there. And I completely agree. Women definitely good listeners. And for me personally, I feel like at times I've been more passive and been a note taker, and I've had to learn, from strong women colleagues and from strong male colleagues as well, how to put my best foot forward and be more assertive in the workplace and really kind of fight for my spot and earn it and stay there.
Yeah. And maybe sometimes with clients too. So you will do this.
Yes. Yes.
Or you more like you will not.
Yes. Yes. Completely agreed. Yeah. So
you will not deduct all your haircuts.
Yes. Yeah. Completely agreed. Yeah, definitely.
Now that you're at Sute, and you've been doing this for a little while now, why don't you tell me some of the things that you think people most misunderstand about what you do, or the field, just the field of tax preparation, tax planning?
Right. So you kind of touched on it when we started. I think people, when they hear taxes, they just think, oh, boring, mundane, something you have to do every year, April 15th. They don't really get excited about it. And naturally, why would they? But I think that at our office, we take this approach of excitement about taxes, and we want our clients to be excited about the opportunities out there, and we want to be the ones to tell them, hey, let's see everything you got, and let's help you, achieve those goals that you have, achieve those financial needs that you have. And so, there's not a one size fits all for clients. And so that's why we like to have clients come in, get to know them, get to know exactly what they want and what they need, and get them excited about the opportunities that I'm sure that they do not know about. So it's very exciting for us to implement these ideas and opportunities. And we hope that clients get excited too.
One of the questions we get here sometimes is, hey, I've gotten a new job, or I keep having to pay taxes, and my CPA told me to change my W-4, but didn't tell me how to do it.
Right.
What are some W-4 tricks?
So W-4s, I remember filling out my first one, and it was just one sheet of paper, and I put single and zero, and then I never thought about it again. And I feel like a lot of people do the same thing, but they've recently revamped the W-4 because I feel like that was a one size fits all, and that's not how taxes work. Everybody's situation is different. And so we have so many married couples that come in, and every year they're owing, and they just don't understand why, because they filled out their W-4, married filing joint, zero dependents or one dependent, and every year they come in owing. And we see this all the time. Thankfully, they revamped it, and we highly recommend assessing every year, or at least every few years, when jobs change, when pay increases, looking at that W-4 and figuring out if you're withholding properly, because most likely you aren't. You can there's one of two options. You can either go online, and there's a nice little easy questionnaire on the IRS's website where you put in your pay stub, and it'll tell you, yes, you're doing good. Oh, maybe not so good. Or you can use the form itself. There's a nice chart on the back. Where we see the biggest discrepancy is when you have two earners that earn different amounts of money, which is the case probably 9 times out of 10. Wife earns X amount, husband earns Y amount. In those cases, you're probably not withholding to account for your spouse's pay. And so the W-4 helps you achieve a more equitable, more accurate representation of those withholdings. So I would suggest either going online, using that easy tool, or printing out the W-4 form and going through that, although it can be kind of tricky. We walk people through it all the time. Get on the phone. It's a quick 15-minute conversation, but it saves you so much money come April 15th. So
if you have a wife that's a physician and a husband that's a high school football coach,
right?
He probably needs to have a higher withdrawal saving or tax deduction rate.
Yes, absolutely. Yeah, he's withholding, assuming that she's making the same amount of money, when in fact that's not what's happening. So, adjusting those withholdings can definitely save so much time and money come the next year. And hey, if it's too much next year, you just adjust again. It's not an easy black or white thing. It's just a science that you have to fine tune to work for you and your family.
What are the most missed opportunities that you see?
When we have new clients come in where we see lacking opportunities or lack of awareness is usually around retirement and charitable contributions. They're either, starting with retirement, they're either not taking full advantage of retirement planning. And so that's working not only with us, but with their financial advisors as well to find a good balance between what they should be withholding from their checks for retirement. And then also, again, charitable contributions. We actually were just talking about a client this past week who every year they give, $5,000, $6,000, $8,000, but they're still coming in right beneath that standard deduction limit. So while obviously they're the charity they're donating to is getting benefit, they are receiving no benefit on their tax return for those donations. And so, we had the idea, okay, wait, maybe instead of paying that, donation in December of 2021, you wait and do it in January of 2022, and then again in December of 2022. So then you're stacking your contributions and getting that full benefit for it, next year. And so I think those are like little things that you would never think about, without the advice of a CPA or a tax professional, because we see this day in and day out, tiny little opportunities that can save you money in the long run.
What about mortgage deductions? You don't really get to deduct those much anymore, but everyone thinks, and this is not really a missed opportunity, I would say, but just probably misinformation.
Right. And the mortgage interest deduction, it is limited, on the certain amount of debt, after the tax change in 2017, you can only deduct interest on up to $1 million of debt. And so people don't always realize that. And then also the standard deduction limit is so high now that it's affecting, people think that they're getting benefit out of certain things when they're really not,
Yeah. We're very passionate about having a paid off mortgage in retirement.
Mm-hmm.
And so we obviously have to plan that in advance, or sometimes there's opportunity to do lump sums and just get it knocked out once they stop working. But that's usually the first question I get is, well, I'm not going to get a tax deduction. And I kind of chuckle to myself because I'm like, well, I understand the concept, but even if there was a tax deduction, why would we spend $12,000 in interest to save $2,000 in tax? How about we just don't spend $12,000 and pay $2,000 more in tax?
Right.
But more so now because the income in retirement, your income drops so low, taxable income, that there's really no reason to be carrying a mortgage for a deduction because there's no way you're going to get there.
Right. And even speaking to that point, I know we've seen it on some clients that we share with you guys. If they're in retirement and they're still charitable and they're getting RMDs, and maybe they don't necessarily need that required, distribution, instead of getting that money and then paying it straight to, their church or their charity of choice, instead having the retirement company, the payer of the RMD, pay it directly to the charity, then it comes out of taxable income. They're getting benefit from that charity deduction that they weren't previously getting because the standard deduction is so high.
Yeah. All right, let's talk a little bit about another deduction that I'm not so wild about. I don't think you guys are either. But let's talk about land conservation credits. Maybe we talk about a little about what it is first, and then are they all bad?
Right. Yeah. I mean, years ago, it was the thing to do, having these land conservation easements, and I probably can't speak like perfectly to them, but I'm going to try my best.
Yeah, that's
fine. These land conservation easements were taking, tracts of land that were beneficial to the government agencies and donating that land, to the government and saying, this isn't going to be used for any purpose besides whatever the government deems it to be used for. And usually we would take, a fair market value deduction for those land pieces. And they were all great a few years ago, but now the IRS is attacking almost each and every one of them and completely disallowing them or taking a much lower appraised value for those.
Right. Well, some of them were saying, well, this was going to be a $15 million shopping center. And when you looked at the details, it was landlocked. Like you couldn't even put a road.
Right.
There's no way it was going to be anything but what it already is.
Right. Yeah. So probably, definitely we don't recommend clients to invest in those now because of the attack from the IRS. Right. And we assist clients now with the defense of those, although there's not much we can do from our side. That's where, your tax attorneys come in and really start to try to defend them. But we aren't seeing much success on those, which is unfortunate. But
yeah, I would think it'd have to be very conservative. But the whole idea of the opportunity is to not be conservative, is to get as much tax deduction as
Exactly.
possible.
Right.
So again, it's one of those areas that people talk about. It's water cooler talk. This is about a land trust. I'm saving this amount in tax. Anyone
Right.
tells you that at this point, then you just maybe offer them a coffee as they're getting, or a beer as they're getting their audit done.
Yes, exactly. Yeah.
And they owe thousands and thousands of dollars in back taxes.
Yeah. Exactly.
Now, another one that seems to be more legit, though, and I know it's still in Georgia. It's not as active, but it was the movie credits in Georgia.
Mm-hmm. And we assist clients with those each and every year. Great opportunity for savings with all of the films that come to, and TV shows that come to film in Georgia. They're offered, more tax credits than they even know what to do with. And so these tax credits are transferable. And so what we can do is we go through a broker that manages these credits, and we buy them for our clients, or our clients buy them for themselves. And then we're able to usually get a 10% return for them on those credits. And the only thing with COVID, it's thrown a little bit of a wrench in the amount of credits, but we fully expect it to recover and bounce back in these coming months and years. And it's a great tool.
And these are state credits, not federal credits.
Correct.
So
yes.
You'd have to have is there an income? Is there a rule of thumb on how much income you're working with? I mean, to me, it would have to be well over $200,000 a year.
Yeah,
probably,
definitely. Right. Cause if your Georgia tax liability is $50,000 and that's a high amount, and so to get, money back from this, opportunity, you would spend 50 to make 45, or around there. So, it's a great opportunity for those who have high income, high Georgia tax bills to really save some money. Mm-hmm.
What trends are you seeing for 2021 that maybe we should be aware of? Yeah,
so ever since the tax reform change in 2018, we're still kind of working through all those changes, but we have a new president who is considering legislation, and one of those is increased tax rates on capital gains. And so normally for us as CPAs, we're always deferring income. Let's defer as long as we can. But now we're sitting here thinking maybe we accelerate that income. We aren't sure what's going to happen with those capital gain rates or when they're going to be effective. So it's just something that we're kind of sitting on the edge of our seat waiting to hear about. And so not much we can do at the moment, but just be ready for whenever that does become effective, and be ready for our clients to make moves if they need to, and advise them on best options forward.
If you're a business owner and you're looking at selling this year or next year, I would say that your safer bet is probably to be selling your company in this tax year.
Right.
But we're not sure.
Right.
We're not sure.
Exactly.
It's interesting to see that there are some moderate Democrats. Didn't know they existed, but there are some moderate Democrats that seem to be a little more level-headed about these tax changes.
Right.
So that's kind of your fighting chance of not being taxed out the wazoo.
Right.
Is that we come up with some policy that's in the middle of where we are now and where many want to go.
Right.
That's something we're watching as well. I mean, we think about Roth conversions.
Mm-hmm.
The a couple of years, or I guess it was last year during the CARES Act, the IRAs, the last to die. So you and your wife or spouse pass away, and then those IRAs have to be taxed over 10 years.
Mm-hmm.
Where before it was called a stretch IRA. You just take a required minimum distribution out over the beneficiary's lifetime and then their beneficiary's lifetime, right? That doesn't exist anymore. So we keep looking at ways that we can convert IRA to Roth so that we're growing tax-free and we don't run into an inheritance tax kind of issue.
Right.
But even that's hard to judge.
Right.
Because there's a good chance that you do a conversion today, and by 12/31, there's a whole new tax code for this year, because they've talked about making it go in arrears, right?
Right.
Yeah. So this is probably one of the harder times I would imagine. I remember anyway.
Right.
Where you're trying to do tax planning and trying to figure out where how the game is going to be laid out. And you don't even know what the board looks like at this point.
Right. And I know Biden mentioned that it was possible that it would be effective as of date of announcement, which is not anything we've ever heard of before. We've heard of retroactive, but date of announcement would be a totally new ballgame. So we're hopeful that if anything, it would be retroactive, but up to a certain date, date of passage, as opposed to a previous date of announcement.
This is going to be a very interesting year for estate planners and for CPAs and financial planners all alike, because if something is done that fast, there's going to be a lot of movement
Right.
to make changes to your personal wealth. And what's concerning to me is really, these are the wealthy people. These are the wealthy people. You know, we run a pretty large wealth management firm here, and no one really thinks they're wealthy.
Right.
It's funny. It's kind of funny. You have someone with $30 million in net worth, and they don't think they're that wealthy because they
Right.
know somebody that has 100.
Right.
Right. You have somebody who's just starting out and they have no debt, and actually they're doing on a pretty good track.
Right.
But they think, oh no, I don't really have anything. But it's looking at even not just so much tax law, but just estate planning. You know, the death tax. If that actually comes back to $1 million per person, $1 million isn't a whole lot of money.
It's not. Yeah.
So that's going to be detrimental to the middle class at that point, because that
Right.
includes your home.
Right.
And most people have at least a $300,000 home, right?
Right. Yeah. So exciting times. I mean, for us, we love to learn and love to stay on top of this stuff. So it's definitely going to be exciting to watch.
Well, Jordan, thank you for coming in and joining us today, and we enjoyed learning more about you.
Yeah.
And you guys can be reached at Sute CPA.
SuteCPA.com. Yes.
right?
Yes. Correct. Yep.
All your contact information can be found there.
Yes, it can be. Thanks for having me.
All right, we'll have you back again.
Thank
Thanks.
you.